points from there.
Okay, so let's take it to our first guest then. Peng, who's the Asia Pacific Investment Strategist at Citi Private Bank, joins in to make sense of all that's happening globally. Hi, Ken. Morning. Thanks very much for joining in. So we've seen the Fed chief warn that, there would be high interest rates persistently for some time now. So what do you make of the future trajectory? Do you think 75 basis points is not ruled out now at the next meet?
Yeah, well, look, I think September, the odds are moving more towards the 75 basis points. We still have to wait to see what the payrolls and the inflation numbers show, but I don't think it's going to make that much of a difference unless it comes in as a big shock. But I have to say though that the Fed is kind of forced to say what it is saying now, and how the rate situation pans out later on, especially into 2023, I think still depends a lot on the data.
As we pointed out, the two important data points will be on Friday, the non-farm payrolls data, and then on 13th of September, the U.S. inflation print for the month of August, and both these two will feed into the September FOMC meet. So Ken, you would bet on 75 basis points?
Yeah, I think that's probably becoming the more likely scenario, right? The Fed, interestingly, the Fed will do whatever the market tells it to do the night before the actual meeting. So we'll see where the consensus is, how they interpret the data, and the Fed probably will oblige.
How much of the mid-June rally that we saw globally, and global indices rallied between 15% up to even 20%, even markets like India had a phenomenal rally in the last 2 months. How much of that was predicated on a dovish Fed, a Fed pivot, or the Fed even pausing? And in that context, given what we've heard from Jay Powell, how much are we likely to give up in terms of gains? What could be the extent of retreat from here on? 5%, 10%, or even more?
So the rally, I think, is predicated on something that was impossible: a dovish Fed and strong economy. So continued profit growth plus dovish Fed. So that's kind of too optimistic. So now I think we have to deal with the fact that the Fed will remain hawkish until the economy fails, or recession comes, right? And so I think the prospect for equities is probably poorer. I would not be surprised at all if all of the rally since June were given up.
All right, Ken, good morning, and thanks a lot for joining us. I mean, absolutely right. I mean, even before this, a lot of the Fed members were sounding very hawkish. Fundamentally, nothing really has changed in his speech, and even the dovish Fed members were sounding quite hawkish in the days leading up to Jackson Hole. But considering the fact that, right now we are factoring in a 75 basis points hike at the September meeting, do you think that with this, most of it is already factored in, or you think we could see a very sharp fall after that? How much of the 75 basis points, do you think is already factored into the markets?
Look, I mean, September is it's important, but it's not pivotal to me. What is pivotal is how will the economy react to the Fed tightening that's already happened, and the rate hike plus QT that's still to come, right? Because remember, in September, the Fed has promised to double its quantitative tightening size from 47.5 to 95 billion per month, and that's something that the market has not really experienced before. And so I think the liquidity situation beyond the September meeting is the key question here, in addition to where the rates might go.
So Ken, then how are you looking at especially Asian equities, and within that, say, the Indian market, and also with regards to the dollar, which we're likely to see strengthen from here on? What is the upside to your mind?
Yeah, so I think to the extent that Fed remains hawkish, until the economy shows more signs of weakness, perhaps towards the end of this year, we have this few months ahead of us that could be strong dollar, rates staying elevated, and risk sentiment quite shaky. So I think in that environment, those markets that are more sensitive to the dollar and interest rates, and I think India is one of them, are likely to be more vulnerable. Yeah.
Talking about markets being more vulnerable, you made a point. You said that you would not be surprised if global markets give up their entire rally from mid-June. For the Indian markets, it means a nifty level of 15,000, 15,500. Is that your base case scenario? We head down to those levels? And do you think at that point it's a bottom? And how would you approach it from a portfolio point of view? What's the call?
Look, I sorry, but I don't make point forecasts. I think where we were back in the middle of June was I think a full cycle Fed tightening priced in, plus a little bit of recession priced in. Now, that's just not the case, right? So next year, looking at U.S. Earnings per share, we're looking for a 10% decline. The consensus at 8% plus growth, and so I think the gap between the market and expectations is fairly large, and I think investors should be focusing very much on quality. You want to make sure that the companies, if you're holding equities, the companies that you're holding have stable earnings, have the ability to grow earnings and keep dividends through downturns. And aside from that, we're still overweight, most heavily overweight in investment grade bonds, as well as U.S. Treasuries.
All right, Ken, if I can, come back to the Indian markets. We have been, of course, talking about all of these inflation concerns, recession, what's going on with crude. In spite of that, our markets have really sort of gone ahead and just managed to climb every single wall of worry. And we're not that far away from the all-time highs as well. So we've also, by the way, seen all of the flows come back in August. Do you think that is something that could sustain? And in that context, where would India lie in your pecking order?
We at this point we tend to be fairly defensive in nature, so we don't like markets that are fully priced, and so we have a neutral allocation to India. We have underweight in U.S. equities, and we have underweights in global equities in general, and biggest overweights in fixed income.
Okay, so underweight equities in general and overweight fixed income. Ken, it's a pleasure speaking with you, but unfortunately we're out of time right now on the show. But thank you very much for joining in. Get into a break on that note. On the other side,